It's the calm before the storm, and many company CEOs and their finance teams are looking at their balance sheets and asking what can be done to make sure they can weather that storm. Today, we have three alternate fund managers to give us their insights. My name's Nick Samios. I'm the fund manager and director here at Hermes Capital, and you have tuned into Lunch Money. We are the online and social media home for workout, special situations, and capital raising professionals. Insolvency moratoriums have been extended. JobKeeper and JobSeeker are about to start tapering off. For many businesses, bank loan repayments and deferrals are coming to an end. And like I said before, it is a good time for company owners to look at their balance sheets and go, well, we know there is this thing is going to come to an end, whether it's January or March next year, and we need to make sure that we're all in good shape. We've maintained our capabilities and our teams, and so that we can make the most when things, when we do hit that cliff. And whether or not that means opportunities or just, as I say, bolstering the balance sheets, now's a good time to think about that. And so we have some special guests. I'm going to start off by introducing Lina Kolomoitseva. G'day, Lina. How are you going?
Hi, Nick. Thanks for having me.
Lina is investment manager at LCM, Litigation Capital Management. She's been there for about six years almost, and you've got a background in law. You're from Adelaide?
I certainly am, yes, but in Brisbane for the last couple of years.
Yeah, so you're in Brisbane. So we were saying a little bit earlier that I'm pretty sure the restrictions are going to come off there sooner than you think. But do tell me, what is it that's been keeping you busy these past couple of weeks as a litigation funder?
Sure. Well, as a litigation funder, what keeps us busy, apart from really managing our existing investments, is an ever-increasing number of applications for new litigation finance. When you look at our sort of global footprint, we're still seeing a consistent flow of applications in arbitrations, in commercial claims, in representative proceedings, and still in insolvency. But the one thing that has been really interesting and has been really encouraging is the uptick that we're seeing in inquiries from our corporate clients. The reason I say that's interesting and that's encouraging is that really litigation finance had its beginnings in insolvency and later in class actions, with both of those spheres being ones in which clients would only use litigation funding out of necessity. So it's because they couldn't pay their legal fees without that assistance. But really, litigation finance has just developed so dramatically since those origins, and it's developed into a product that can really be used in circumstances well beyond that. And LCM in particular has been really keen at sort of driving the awareness and driving the education, and the fact that litigation finance is not just for impecunious plaintiffs. It's not just a one-trick pony, but it's really a finance tools that corporates should be using to their toolkit and using effectively. And I think really this year has seen, as you say, management's been taking a careful look at their balance sheets, and I think that's really seen a resulting acceleration in awareness of litigation funding and an increased acceptance of it as a toolkit, as a finance toolkit product. So for us, that's really seen sort of an uptick in inquiries, and that's seen an uptick in actual deals that we've done with corporate clients as well.
Okay, well, the first thing I do when we finish here today is I'm going to Google Epicunious. Don't tell me what it is now, because it's spoil the surprise. But we have a lot of lawyers and insolvency people that watch us, but we also have finance brokers and other business advisors who may not be 100% au fait with litigation funding. So just to sort of peel it back, just to sort of the barbecue definition of what it is exactly that you do.
I hate to see a barbecue at which we're talking about litigation funding, but nevertheless, I guess a good starting point is really to highlight that the way that litigation funders view a piece of litigation is as an asset. So that's sort of the starting point. And litigation funders and LCM is uniquely positioned to ascribe a value to that asset. So, contingent claims are tricky things to value, but this is really the core of our business. And when that's the starting point, you can sort of see how once you recognise that as an asset, you can see how it can be used as a form of finance. So what we do is really leveraging against the collateral that is a claim that a company might have. We can pay the legal costs that are associated with advancing that claim. We can provide an indemnity for any adverse costs exposure, so the costs that you might have to pay if you lose. And we can also monetize against that claim. So we can actually pay cash up front or regular payments against that claim for certain periods. The only way that we get paid as well is if the claim is successful. So it's what's called a non-recourse product. The only recourse that we have is from the recovery that we can make in that piece of litigation. We don't secure against any other assets of our clients. If the claim doesn't succeed, we simply don't recover. If the claim does succeed, we recover the amounts that we've invested plus a commission.
Okay, so I mean, so really, what's interesting is, obviously, a lot of the lawyers watching would automatically think of litigation funding, but a lot of, we might have commercial finance brokers who are sitting down with their clients who are scratching their heads, looking at the balance sheet and wondering where they can find money, and maybe it is some sort of piece of litigation that's blown a bit of a hole in the ship, and that's something they should think about. Listen, Lina, we're going to just put you in the waiting room while we introduce our next guest, Stephen Mitchell. G'day, Stephen. How are you going?
Good.
Fantastic. Stephen's the CEO of Resicom and Oak Capital. And tell us what it is that keeps you busy these last couple of weeks, Stephen.
Yeah, well, not getting my hair cut, Nick, is one thing that's not keeping me busy because lockdown in Melbourne 2.0 is dragging on and on and on. So, look, with Resicom and Oak Capital, we ultimately finance generally small business clients. We have an element of distress that's normally in those clients as well. So it's been a unique market for the last few months. We've definitely found it's actually a lot quieter than we would have thought. Very different to a GFC event that actually kept us very, very busy during that time. We feel that that's not going to be hitting us till probably next year. So we've still been seeing applications come through, but not to the point that many people would think is occurring. I think that's given the moratoriums on all the debts out there. A lot of people are holding on to the transactions rather than moving at this point. They're not forced to move, which we will see coming in the few months ahead. So look, it's a unique time for us. So far, properties are holding up, and we are still able to lend, but we're just being a bit more cautious on what we're looking at, with the view that 2021 is going to be a bit of a tougher year for property. And we are a real estate-based entity. We lend only on real estate. We don't lend on any other assets. And as a funds manager, we have a responsibility to our investors. So we're quite prudent on how we look at our deals and ensuring every single one we do that is well backed by the right asset as well.
I guess you're a little bit at the opposite of Lina. A lot of finance brokers watching would know about you, but there'd be other accountants and lawyers that don't necessarily know exactly what it is you do. So just in a nutshell, you guys obviously do commercial. You lend against resi. Just sort of flesh that out a bit.
Sure. So two sides to the business. So we have the Resicom side, which essentially is a mortgage manager. So we rebrand other lenders' product. And in that space, we're heavily a low documentation type lender. We look at clients that have anywhere from zero distress right through to an insolvency event, and they need money generally within a couple of weeks, and we can consider that application and move the money out to them. We deal with brokers there and accountants, planners, insolvency clients as well. Then on the other side, we're a funds manager. We have two funds in there. So we have a retail fund and a wholesale fund. So on that side, we obviously act for investors that want to obtain a reasonable yield on their money. And they're all secured against mortgages that we lend out. So if accountants have clients that have a tax problem that they need to pay out in 2 or 3 days, that's really the market where we like to play, is move super quick and advance against their property. So providing they've got some equity, then we're going to be able to consider that loan, providing it's a business loan as well. Also, there could be a developer that's done a development, now holding the ball, and he's got 10 assets left he hasn't been able to sell down. We would do a residual stock type transaction and structure a loan so that client can come in, obtain their money and sell those assets down over a 12-month period or so.
Will you fund the development itself?
We don't do development ground up. Yeah. So we've done the odd one where there's sufficient equity in the land that it's a fairly basic type of transaction we can fund against the land value for a build. And we also do second mortgage plays where they're at fixing stage or lockup and they need 300-400 grand to finish. At that point, we might get in, but we're very much an in and out type lender, bridging a space. So we're not there to do a ground up 20-unit construction. And to be honest, that market quite flooded. And guys do that very, very well, and that's just not our space.
I'm just curious. A lot of the deals that you do would be deals historically that banks won't necessarily do. But I know that speaking to brokers, applications are just taking a lot longer to turn around. In the old days, you could, if you're borrowing money for a car, you could basically turn it around same day. And these days, that loan might be taking, a week. And I'm sure mortgages are the same. Are you finding that you're getting opportunities just on the basis of being able to complete them quickly? Like it might be a bank credit, but just needs to be done quickly, or?
Yeah, so look, normally they're at least one step out of a bank, because in Australia, obviously, we've got the banks, let's call them first tier, second tiers, which are like a Latrobe Financial, Pepper, Liberty, those style of lenders. So as the banks have tightened up on their lending criteria, the second tiers have continued to grow their balance sheets, and they've been able to buy a lot more of that bank credit. But we pretty much sit just behind them. And at times they cannot move in 3 or 4 days. So we do pick up the odd deal where it's a purchase. The client has totally clear credit. There's no other reason why they come to us, but they have been let down by the bank, or the bank's found some other slight issue with their tax return or some other matter for them on their credit, and has said no at the last minute, and the broker's left holding the ball. They've got to settle this deal. So we can come in, quickly assess that asset, generally same day, fund them in. They take a deal for 3 or 4 months, and then they fix the problem, refinance away. Perfect client for us. They come and go. And we feel the solution that they need. But we also just get a lot of clients that, it's generally an income point of view. They can't justify it or put it just at this point to a sufficient amount to satisfy the banks. And after the Royal Commission, obviously the regulation side of the way the banks underwrite loans has increased dramatically, which has provided opportunities for the second tiers and our sort of market to have a much more common sense approach to assessing a business's ability to pay a loan. And allows us to have our market that we sit in and move quickly to provide finance for them.
Okay. All right. That's interesting. What we might do now is bring Lina back. We are in different parts of the market, I suppose, where Stephen and myself are sort of more at the small and medium size, and Lina, you're talking to a lot of corporates. I just wonder. I know that in our industry, in working capital finance, because there's been so much uncertainty, and also because of JobKeeper and moratoriums, people have been reluctant to enter into new finance arrangements. They don't know what's around the corner. Their cash flow is okay at the moment because the government's supporting them. I think, Stephen, you were saying you experienced a little bit much the same.
Yeah, absolutely. And I think we've seen that slowdown in application basis, and I believe a lot of that is, the media is calling them the zombie companies, and I think there's a fair bit of that going on, where clients just do not need to obtain the capital right now because they can hold up on the bank, they can hold up on the landlord, they're not getting the calls from the ATO, and a chunk of those are the reasons that we provide finance in many cases. The ATO needs to be paid out, we come in. Provide that assistance. So those things just aren't happening. I do feel, though, inquiries slowly picking up now, and coming towards the end of September, the banks aren't just going to totally roll over all their deferred mortgages. They're definitely going to be looking at their books and going, you know what, there's 25-30% of the people here that could probably be paying, and start putting pressure on people to start making their payments again and getting their accounts in order. And we'll see also landlords that just can't continually hold on. And are going to need to start doing something. But those incentives flowing from the government are definitely creating a false market, I think, at the moment.
Yeah, look, I find that in the workout bankers, I think there's a song by Pink, go away, come back, go away, come back. We've tried to get deals out of the banks, and the bank's saying, yeah, we want this client gone. But then, no, they don't want them gone. They actually want to hang on to them and cuddle them a little bit more. And then, so that I think that the banks, they're in a bit of a twilight zone. I wonder, Lina, in your space, I wonder if the opposite might be true. With uncertainty, are people more likely to pick up the phone to you? Like, whereas with myself and Stephen, because uncertainty sort of plays against us, they're not sure they want to make the commitments. But in your space, maybe it's uncertainty that's driving the call.
I think uncertainty will certainly ultimately lead to an increase in the number of disputes, which will ultimately lead in an uptick in the claims that will come to us. But I think one of the key drivers that we're seeing in the uptick in the calls that we're receiving now is really as you say, sort of that review of the balance sheet and really having a look at where the cash is going. And I think we're in a slightly sort of unique space because litigation is long term. It's a long running, often litigation will go for 2 or 3 years. So it's sort of not just a cash drain today, it's going to be a cash drain for some time to come. So when you're sort of making those assessments, it's sort of it's got more of a tail on it. And I think because of that, I think the corporates that we've been dealing with have had sort of thought bubbles for a long time around considering disputes finance, whereas because of the current climate, those thought bubbles are really sort of floating up and they're moving into sort of more concrete discussions and ultimately more concrete deals. And really, I think the driver there, there's a few. If you had another hour, I could talk about all the reasons why disputes finance ought to be used out of choice, but just to focus on some key ones. Really, cash is sort of a major factor. Instead of having that monthly drain on cash, which will be for legal fees, particularly if we've got a client that has got a number of claims, that cash drain can be really quite significant. And as much as people love their lawyers and as much as they love paying them, really, I think a lot of discussions are being had about, well, is that dollar better used in our core business? What's the opportunity cost of us using that dollar for legal fees instead of using it in our profit-making functions?
Is it also a bit of an acid test? If you've got a case, you're not sure, you're not sure if it's valid, and you go, well, you know what? Let's if we can get a litigation funder to take it on, then yes. If they're not prepared to take it on, should they be walking away from it?
Absolutely, and I think a litigation funder will never replace a trusted advisor and a legal team that will ultimately prosecute the case and the advice that they offer. We do not offer legal advice, but we do come to every case with a unique viewpoint, particularly because we're really keenly focused on the recovery and really what the value of that claim is and what is it that we're going to be able to recover from that claim. And quite often there might be really good claims that when you actually work through the likely value of that claim and really what the defendant is going to be able to pay, the ultimate bottom line number on that is quite different. So I think we sort of bring quite a unique viewpoint to it. And you are quite right. I think having a litigation funder on side does sort of provide a bit of a tick of approval for the claim, and it does strengthen your position in negotiations with the opposing party, because you do have that expert litigation funder that has come in, looked at the case, approved it, and invested in it.
Yeah, and you're sitting across the table from them, and you're thinking, these people get a payday if they beat me. So I suppose there's all of that as well. Okay, I wonder. We were talking a little bit earlier, Stephen, about the old risk curve. Obviously, as risk goes up, pricing goes up. If you overprice the risk, then you're probably going to miss out on the deal. If you underprice the risk, in the fullness of time, you're going to end up losing money, really. We were talking before. There's obviously a lot of new players in the market. Where are you seeing the dynamics of price and risk?
Yeah, so look, I think the best way to sum it up, it's a race to the bottom at the moment, and we're sort of just holding on tight and sticking to our knitting and trying to keep our pricing roughly where it's been most of the time. There's deals that for sure necessitate some reduction in pricing, and investors can accept that as well. But otherwise, we're still looking at this as a very turbulent time, and it's a 1 in 100 year event. No one's been through, and the pricing is going the opposite way to what it did in the GFC. In the GFC, pricing went through the roof to fund a loan quickly. Private lenders were able to charge ultimately what they wanted to, rightly or wrongly, but that was the way it worked. And today's market, it's the complete opposite. We're getting private lenders competing against us that are returning their investors 4 or 5% when they, a few months ago, were returning 7s and 8s.
Everybody thinks they can do lending, don't they? There is a lot of cash out there, and you do find yourself competing against some solicitor or some wealthy individual who thinks they can have a crack.
Yeah, I think the risk though for them is you're not looking forward necessarily to 2021. They're buying deals to move money, literally just to get into the market because there's nowhere else to obtain a yield, unless you're in the share market. But again, that's top heavy as well.
Yeah.
And people are just moving money, getting it out. And we've seen some of the deals, we're not only competing on price, but a lot of the time we're competing other people's LVRs, which are breaking the long-standing rules. And in residential private lending, it's generally 2/3. And guys are breaking those rules hand over fist at super low rates, low fees. And, we're strong believers are going to come back and bite you at some point when the market has to react to this event. It hasn't had a reaction yet. To lend like we are, but you've got to have a cautious view, and there still needs to be some margin and pricing in case the rainy day comes and hits you hard.
Well, as you and I both know, I mean, if something does turn sour with the loan, it's not like let's say it's if it's that factory unit across the road, and all of a sudden they can't pay anymore. They don't go, you know what? Fair enough. Here are the keys. Good luck with the marketing. I mean, it might take you some time to actually get possession of that property. I wonder, Lina, in your space as well. I mean, there are more litigation funders. I suppose you need to differentiate more. But are you finding, are you coming across some matters and just someone's prepared to take stupid risk or misprice it, and you find yourself walking away, or has that not hit your market yet?
Well, we very carefully assess all of the applications that are made to us. Our percentage of applications accepted sort of ranges between about 3% and I think 7%. So we really have a very strict process for the claims that we do fund. And in that sense, it's sort of something that we don't stray from. So we make our own assessment of the quality of the case without looking at, whether another funder might be interested in it. We don't sort of price things in a jealous fashion. But what
jealous
we do,
pricing. Okay.
Jealous pricing. But what we do is once we've made the assessment of the risk and what the likely value of the claim is, that's really what we look at when we offer our pricing. We've been in the industry for a very long time. We're used to competing. There is more competition. But I think what we find and what we consider is important is that pricing is one thing, but there are many other factors that a funder brings to a claim that are not necessarily just pricing focused. So first of all, we're comfortable with competing on pricing, and we're aware of what the market is doing, and like I said, we evaluate each case carefully. But also, I mean, we are one of the longest standing funders globally. We're publicly listed. We've got excellent access to capital. All of our financials are transparent, and really, those sorts of characteristics are not commonly found in the market. And the other thing that I think, is sort of a vote of confidence is the amount of repeat business that we have, particularly in the corporate and the insolvency space. And I think the fact that we've had people that have worked with us, enjoyed working with us, and achieved a successful outcome, will sort of likely bring them back.
I think it's interesting. I mean, evaluating assets in your business would be quite a challenge. Stephen, I don't know. We've got a graph of Westpac the other day, just on the subject of valuing assets, came out and made some predictions on Sydney home prices to jump by 14%. I think what else have we got there? All the markets are going up. I mean, that strikes me as being a little bit premature. What do you think? I mean, far be it from me to second guess what some economist at Westpac says, but what do you think? Just you've been around.
I think sometimes the problem is if you ask another economist, you're going to get the opposite graph. It'll go the totally opposite way. So, it works a bit more for Westpac shareholders to make sure things are going to look positive moving forward, not that they're going to have massive write-offs. Look, we don't really foresee, well, we don't know what to foresee, to be honest, but we don't really see that there's going to be a massive correction. But there's going to be a cooling, and we haven't seen it yet. We get statistics on TV that say, Melbourne's up 1% or a soft line. But then if you actually look at the fundamentals, walk through the city, which you can't do because you're not allowed out of your house, but you'll notice how many cafes and restaurants have actually cleared out already. Something like 46 shops on Chapel Street between Toorak Road and Commercial Road that are already empty. Now, these things have to have an effect. So look, resi houses in the burbs, I think has a much stronger chance of not having such a cooling. The growth, I think, is a bit excited, to be honest. I can't see our economy bouncing back from something as large as this that quickly. I would hope a great outcome would just be to not drop too much over the coming years. Apartments are going to be hammered across the CBD areas. People are going to take a long time to return to the cities. That's already been proven. From what I hear in Sydney, is the foot traffic is still way down, and it's going to take years. Working from home is going to become a thing that I think it'll wear out over time on the vast majority of people. I don't actually know many people that enjoy it, but there will be an element of it that'll be around, and commercial assets are going to get a fair old haircut. I don't know. I think that's a bit optimistic. I hope it's true. Help everyone, and property houses are going up, but we're already at the top of a market, we've all thought. And we haven't really seen it come off.
Yeah, I saw an article, I think it was yesterday, we've got it here, I won't flash it up, but where the New Zealand Central Bank apparently is warning the major Australian trading banks, I mean, they're all in New Zealand, that they've got to get their systems ready for negative official interest rates. Well, God help us when that happens. Lina, let's say there is, let's say that there is economic turmoil next year, and there, asset prices are affected. Does that affect your market?
Well, I think in terms of litigation finance, I think what we would ultimately expect to see is, I think any turmoil results in an increase in disputes, which will ultimately result in an increased number of matters that could benefit from dispute finance, which will then obviously lead to an uptick for us. I think there will be some increase in companies being wound up, so that'll obviously also lead to an increase in some of our in our insolvency space and the claims that we fund in insolvency, still being a core of what we do at LCM. And I think this uncertainty, like we were saying, will continue to accelerate the uptake from corporate clients of our products. So I think in some ways we expect a fairly busy year ahead.
And what about your referrers are mainly, you're mainly working with law firms?
Law firms are a really healthy source of referrals for us, and that's sort of a consistent source of referrals for us. And we've got some strategic alliances globally with some key law firms as well. And just by way of example, we've recently announced a deal with a corporate for a book of 20 claims in the construction space, and that came to us through a strategic alliance with one of our law firm partners. We are fairly proactive.
Just talk us. Just in a minute. Just talk us through that. The book of 20.
Sure. Insofar as it's easy for us to sort of finance a single claim, and the risk profile of a single claim is it's binary, so you can either win or lose, and then obviously the pricing that we offer on that sort of product is reflective of that risk profile. What we can do with, particularly with our corporate clients that might have more than one claim and might have a book of claims, is we can structure what we call a portfolio deal, and that means that all of the claims within that book are cross-collateralized. So the investment that we make on one, if one of the claims loses, we may recover it on another. So that obviously dramatically shifts the risk profile of the entire book of claims, and that really opens up a lot of options for what we can do as a solution for those actions. The pricing obviously comes down because the risk comes down. It also means that we can then include defence actions, we can include regulatory actions, we can include claims that wouldn't be fundable on their own. And so that's really sort of what the corporate portfolio structure is. And what we've got in this particular claim is it's a subsidiary of a global construction and infrastructure business, and we've engaged with them to really fund this book of 20 claims in this portfolio fashion across various jurisdictions, and obviously for a budget for each of those claims to be pursued.
Gee, that's going to keep you very busy, that's for sure. And now tell me, I'm interested to know, what's life like for your, let's take for the solicitors. What are you finding when you're speaking to them? Are they generally busy? Are they all working from home? I know that the large law firms, or the large firms, full stop, that some of them are saying they're not going to go back into the office until mid next year. What are you finding? What's happening in the world of your referrers?
It's really interesting. I think we're quite fortunate in Brisbane in that we've had restrictions eased for some time. Granted, in my building where I've got quite a few bigger firms, it's still really very quiet. And when you speak to different teams, I think it varies from team to team. I think some people, as you said, Stephen, some people don't enjoy working from home as much, so they sort of are keen to get back into the office, whereas others just haven't come back. But I find that, I mean, there was obviously a real adjustment in relationships are really key to our business, and you know, catching up with people and having a discussion about what's happening out there is really important to us. So we had to sort of adjust to the way that we do that, and you know, had a few Zoom drinks and Zoom coffees really early in the piece. But fortunately, sort of at least in Brisbane, sort of seeing a few more people face to face more recently, which has been it was quite nice the first time I got to go to a real restaurant for a real lunch with real people. It was great.
Yeah, that's interesting. I mean, you know, I have played maybe 2 games of golf in 10 years since starting Hermes. It's interesting. Steve might have a laugh. I bet you he doesn't play a lot of golf, but you know, people say when you're working, you know, in a corporate environment, you go, oh, I've got to play golf. It's very important that I play golf. But when all of a sudden you're on your own dollar, it doesn't seem to be that important. But, you know, I went to a golf day on Wednesday and I went to a lunch yesterday. I thought, you know, you poor buggers in Melbourne, that you can't do this. I mean, how do you, because you're a relationship business as well, Steve. I mean, obviously, you know, your ability to execute and deliver is paramount, but you still need to get in front of people. So how are you finding that in the environment that you're in?
Yeah, look, I think you adapt or die, right? And unfortunately, we've had to adapt since about March 11. We had literally about a month gap in the middle where some normality returned, but it got taken away from us pretty quickly. And as I said earlier, this is week 11, I think. People kind of think of lockdown stage 4 has been 6 weeks, but don't forget we were in stage 3 weeks before that, and we've now been in an extended lockdown stage 4 for a week. So, you know, we're 10 weeks in, we've got another 6 easily before anything of any sort of remarkable change. And even at that point in Melbourne so far, there's no internal dining at that point. And that is if you can actually hit his targets. But hey, I'm going to get on a whole other tangent. So from us, we've just had to adapt. We have done one thing for me really is our staff has been keeping sane and healthy. You know, so every Friday we do an event at 4 o'clock today. We do some games. We encourage people to bring some drinks. We've done cooking classes on Fridays with our staff. Every Monday morning we do a hustle together and get the whole group together on Zoom. And then the teams have obviously their staggered meetings throughout the days, and we always just try and FaceTime. You know, normally call a colleague, but now we FaceTime them just to break up their day. And we have a lot of single staff that live in an apartment, and they're on their own, literally on their own, totally. Like as hard as it is with 2 little tackers running around, I do have something to break my day up. Sometimes right in the middle of one of these, but at least better than nothing. And with clients, as of October, we're bringing in a BDM virtual lunch. Our goal, they're actually going to send the drinks to the relationship that we're going to have the chat with the day before, so they'll have it there, and then we just all get together. We do steak nights with different important clients. Everyone has to have their steak and their wine ready by 7 o'clock, and then we just chat. You just got to just try it. But existing relationships are easier because you know each other. Trying to get new ones is very difficult.
And I guess, Lina, where you are, it's a little bit, you know, you guys are allowed to walk around and all the rest of it. I reckon that all of this stuff's going to end a lot sooner than you think, because I think that, you know, you are getting good numbers in Melbourne. You know, the things, it's all coming down. And I think that there's going to be a lot of pressure. I'm on the optimistic side of all of that ending sooner. Listen, we're up against the clock. So I'll just ask if you've sort of got any final thoughts or comments before we wrap up. I'll start with you, Lina.
I mean, I guess, I think you mentioned that there might be some of your viewers and listeners that haven't sort of considered disputes finance as one of the ways that they can ease some of that sort of cash flow concern that they might have. So I guess in that context, just sort of, encouraging people to reach out and have a chat.
Well, I'd say to anyone, all of the promotional material on LinkedIn has Lina's profile. So click away and get in touch. Stephen?
From a similar point of view, Nick, thanks very much for having us on. If there's any accountants or any direct investors listening and they want to look at an option for investing, then reach out. We'll go to oakcapital.com.au, and any brokers and clients that need money, please reach out and we can have a chat, and we'll always give you an honest, upfront answer very quickly. That's always the goal.
Fantastic. All right. Well, thank you very much to both of you for joining us today. Thank you very much to those that have watched us live, and thank you to everyone who's watched us on catch up over the weekend. So thank you, Stephen, and thank you, Lina.
Thanks very much.